Fundamental principles of the International Ethics Standard Board for Accountants. Fundamental principles of the International Ethics Standard Board for Accountants. That's what we are going to discuss. The first principle is integrity. The first principle is what? Integrity. A professional accountant shall be straightforward and honest in all professional and business relationships. That's the first principles of what? The fundamental principles. That's the first one. So, as a professional, you must be straightforward and honest in all professional and business relationships. Then, you must be objective. Objectivity is the next one. A professional accountant shall not compromise professional or business judgments because of bias, conflict of interest, or undue influence of others. You must be what? Objective. You must be objective. Don't compromise professional or business judgments. The third one is professional competence and due care. A professional accountant has a continuing duty to attain and maintain professional what? Professional knowledge and skill at the level required to ensure that a client or employer receives a competent professional service based on current technical and professional standards and relevant legislation. A professional accountant shall act diligently and in accordance with applicable technical and professional standards. What do you mean by this? You, as an auditor, need to be on top of the job. You must be up and doing. Meaning that any new thing introduced, you must know it. So you must be competent before you accept the job. If you are not competent, don't. And because of this professional competence and due care, ICA has what you call professional development. Yes. We go for that every year. Confidentiality is our next one. For a professional accountant shall respect the confidentiality of information acquired as a result of professional or business relationship and shall not disclose any such information to third parties. You see, auditors are professionals who are prone to what? Informations. Mean that any information that your client has, you also have some because of your position. When you ask of any information, they can't have it for you. And they are saying that those information you are obtaining from your client's system or from your client or file system should not be disclosed to anybody. Should not be disclosed to anybody. Therefore, every information should be confidential. They say confidential information must not be used for the personal advantage of the professional accountants or third parties. So don't use private information, the information you got for your client, for what? Your personal. However, the confidentiality ends only there. You can disclose confidential information when required by law. If the law says you must disclose it, there is no way you can dodge it. Or professional rights. It is your professional right or duty to disclose. Like the way we discuss, that of money laundering. If you suspect your client to be dealing with money laundering, you are required by law to disclose it. That one is by law, and therefore you are allowed. All right. Professional behavior. A professional accountant should comply with relevant law and regulations and avoid any conduct that the professional accountant knows or should know might discredit the profession. Meaning that a professional accountant shall comply with relevant laws and regulations and avoid any conduct that professional accountant knows or should know might credit the profession. Yes. If you are accountants and then you are, let's say you are dodging tax. It means you are not a professional man. Because as an accountant, you compute the tax for somebody to pay. What about you? You must make sure integrity, objectivity, and independence is another one we are going to discuss. So, for an auditor's report to be of value, the auditor must be independent. Anybody that writes audit reports, because you are given assurance, you must be independent and also must be seen to be independent. You must be independent, number one, and you must also be seen to be what? Independent. What does this mean? Let's go further. A member's auditor's report that is of value, auditors must have what? Independence of mind and be independent in appearance. Independent in mind and independence in appearance. These principles of both being and being seen to be independent are at the center of the role played by independence in auditing. So what is being seen, being independent, and being seen to be independent? Being independent means that with your own body, how do you think about the whole thing, the audit you are doing? Are you independent? Have you seen yourself to be? Have you seen the truth? But having been seen to be independent is that your relationship with people should show that you are truly independent. Let's say, for example, if you are going to audit an organization and they buy you food, you go and eat with the chief accountant. When chief accountant closes, you take his car, two of you go out. You see, so the assumption, the people may presume that this audit is going to be nowhere because you are being seen as not independent. Threat to auditor independence. You see, human beings, we have threats all around. So, as an auditor independence, there are threats to the independence that you will be. Threats to independence situations that may damage the independence and objectivity. Meaning that those threats can damage your independence and objectivity. Once you indulge in those things, it will not make you to be what? Independence. Any threat to independence may be reduced by safeguards. However, any threat that will make you not to be independent need to be what? Reduced by putting in safeguards that are taken by an audit practice. Okay? General categories of threats. There are so many threats. There are so many what? Threats to independence. The first one is what we call self-interest threat. Self-interest threat. This arises when the accountant or the audit firm has a financial interest or other interest in what? A matter. If you are going to audit and you yourself have a share in that company, or you have taken loan from the company, you have a financial interest. Therefore, if people who are not paying loan, or you have something which is financial as far as the company is concerned, then it means that you are not independent. That is what we call self-interest. Self-review threats. This occurs when an accountant is required to review or re-evaluate a previous judgment he has made or action that he has taken. Self-review means that you do the work for your clients, go around and come and audit it. Let's assume that your client asks you to put internal controls in place for them. You see, after helping them put the internal controls in place, then you go around and come and audit the system that you put in place. It means you are reviewing yourself. Or you prepare financial statements. Then you prepare a financial statement. You don't give opinion on it. But you go and act as an auditor and give opinion on that financial statement that you prepared. Then you are reviewing your own what? So we call it self-review threats. Advocacy threats. This occurs when the accountant is in a position where he is expected to defend or justify the position of the client. and act as advocate for the client's position or point of view. Advocacy means trying to support the client in one or the other way. So auditors are not allowed to support or to defend the client or to advertise for the client. You cannot advertise for a client and later on when the client is not doing a good job, you say, no, it's not doing a good job. So advocacy means trying to support or put something. That's why they say this occurs when the accountant is in a position where he is expected to defend or justify the position of the client and act as an advocate for the client's position or point of view. So you cannot advocate for your client and then come and what? Go around and say, come and audit it. Because it will be a threat to you. If you say, this company is a very good company, it's making good profit and the rest, and after doing that, you sign for them and then later you come and audit it. Will you now say that they are not doing good? They are not doing good job. Intimidation threats. This is also a threat. This occurs when the accountant is deterred from acting with objectivity due to what? Threats against him or his firm. Yes, this is intimidation means your client can intimidate you by saying that if you don't give a clear report, we will not what? We will take the work from you. You will not audit the next year's financial statement. It's a threat. So you want to take the job. By that, you are going to what? Compromise. So you give a clear report. Meanwhile, the information on the ground does not support it. Then familiarity threats. This occurs when the accountant becomes too sympathetic with the client's what? Position due to close relationship. Yes. That is, you are familiar with somebody. Then it means it's a threat. It's going to compromise. Let's assume that McDo and let's say Yao were in a school. Then Yao was called Kololo in the school. That's a guy name for him in the school, Kololo. We all completed and we depart from one another. Then all of a sudden, McDo finds himself as an auditor. Then when I'm going to audit my client, we go to, let's say, management meeting or which we call entrance meeting. Then Fuyoyo is the one who is the accountant. I see somebody like Fuyoyo. Then after all these things, when you finish the meeting, I'll go to him and say, are you called Fuyoyo? He say, yes. Why did you attend school? Then we all went to this school. So you are too familiar with the fellow. That one, you are. Because if he does something wrong, can you say it? So you are compromising it. So you are too familiar. Familiarity threats is also another threat. Other threats. There are other threats. Like financial interest test. Like you go and take a loan from the company. Or the company will want to help you sponsor your child overseas. So you also accept. It's a financial interest. So in that case, if they do something wrong, will you say anything about it? Loans and guarantees are okay. I said the loans already. You take loan from your what? Company. Your client company. If you've taken loan, they have bought you. It's difficult to even say anything about it. Or guarantees. You guarantee for your client or they guarantee for you. Either you guarantee for them or they guarantee for you to do your what? Masters or to do your PhD. In that sense, it means you are obliged to tow your way. Then close business relationship. If you are the business relationship, then it means that you are compromised. Employment with assurance clients. Sometimes the assurance clients, like the auditor, the audit firm, may have some staff who leave the work immediately and join the client's employment. Under that circumstances, that means that fellow, once he's a senior officer or is somebody who can take decision, it becomes what? A threat. Then, recent service with assurance clients. Yes. You can also, let's assume that an auditor who leave Deloitte and Touche and take work at, let's say, Unilever. Then, now that, Deloitte and Touche is going to audit Unilever. You see that there is a doubt there because there is a close recent service with assurance clients. Then inducements, including gifts and hospitality. Yes, if they want to induce you by giving you some things or some other things, including gifts and hospitalities, etc., etc. Inducement can be, I'll sponsor your child to do his masters outside. If you do as good by writing a good report, these are some of the inducements we are talking about. And then including gifts. But the gifts, you can take gifts, but the gifts should be so minute, very, very small. Very, very small. And then if there's any hospitality, all these are threats to the audit profession. Safeguarding independence. Yes, how do you safeguard them? There are safeguards. The responsibility for safeguarding independence is shared between the individual auditor and what? The profession as a whole. You see, safeguarding independence is done by the individual auditor himself or the audit firm or the profession as a whole, meaning that the profession will tell you what to do and what not to do. That's where you are trained as auditors. That is where the role of the profession. There should be a culture of independence and a belief in the auditor's independence. That is shared by all partners and employees in an audit firm. Audit firm, like Deloitte & Touche, should incorporate a culture of independence and belief in every staff so that they know that their independence is very paramount. So that they believe that independence is one core area that they need to what? Value. So there should be what? Culture of independence. And then a belief in what? Auditors' independence. That is shared by all partners. It means that all employees in the audit firm need to understand this and practice them. Rotation of the engagement partner is another way of what? Trying to mitigate the risk. The risk. Now, rotation of the engagement partner. An individual should not be what? Involved in the annual audit of the same client company for more than a maximum number of. In Ghana, we have about 5 years. About five years or so. If you are auditing, the engagement partner, let's assume that the Deloitte & Touche is auditing. They should regularly rotate the engagement partner so that another fellow in the Deloitte & Touche will take over. Another fellow who is also a partner should take over. Not only one partner. One fellow taking it is a very dangerous one. Because you'll be familiar with the audit firm and with the clients. Therefore, when they do something wrong, they will plead and you have to forgive them. And that is where the problem is. So, rotation of the engagement partner. The next one is appropriate training. Yes, including training in how to maintain an independent opinion during audit work. So, every employee or audit staff need to be what? Appropriately trained so that they will know that they need to be independent whilst they are on the premises of what? Their clients. Quality control procedures. As part of the mitigating factors, you should put quality control procedures in place. A firm shall have procedures for what? Quality control to ensure that independence is considered in respect of all work undertaken by the audit firm. So, everybody should know that quality control is one of the best things that you need to do when you want to avoid the risk of what? Be what? Compromise. You make sure that everybody knows that quality control is one of the best. Consultation procedures. A firm shall have internal procedures for consultation, whereby questions arising in relation to what? Independence can be discussed. Meaning that there should be a way of discussing what? Independence. If you have a senior officer and you are not sure of what to say, you have to find, you have to get that, do that consultation with what? A senior officer. So there should be consultation or responsibility of the profession. Now the profession itself has a responsibility. the profession which we call ICA Ghana has what? A responsibility. The profession and other interested parties regularly suggest new practices and procedures designed to improve auditor independence. Suggestions have included what? A regular rotation of audit firms. So you don't go and audit a client and continue to audit perpetually. No. After some few years, you need to rotate the audit firm. When I was working with Coca-Cola, we were having different auditors coming different times. After 4 years, the company go in for another audit firm. So that is rotation of the audit firm. The first rotation we said was the partner, the audit partner. So this one is the audit firm itself, to avoid too close a relationship developing between the audit firm and the client over a long period of time. Then the use of audit committees is also another means by which you can what? Mitigate the risk of what? Independence. Provision by auditors of non-audit services. Assuming you are doing non-audit services like what? Review, compilation, and the rest. Now, audit services might include what? Accounting and bookkeeping services, which we discussed earlier. Accounting and bookkeeping services, which is the same as what? Compilation. Taxation work. You assist your clients to do what? To prepare his tax returns and the rest. The outsourcing of internal audit services. These are part of the what? To the external audit firm. IT work, consultancy assignment, legal services. So all these things you can, if you are doing it, meaning that if you are not careful, you can compromise your independence. Making referrals. An audit firm may enter into an arrangement with another entity, whereby the other entity agrees to pay a fee to the audit firm for referring clients. This type of arrangement will create a self-interest rate for the firm. So if you are enter into an agreement with another firm, which means that you will be recommending people to them, it means that it is what? Self-interest for audit firms. However, it is permissible anyway, provided that suitable safeguards are in place. Suitable. And that suitable safeguards. Now let's come to the next, which is confidentiality and conflict of interests. The basic principle is that the duty of confidentiality, as I discussed with you, that auditor need to be confidential. It's a fundamental principle of what? Professional behavior. That information obtained in the course of what? Professional work should not be what? Should not be disclosed to others or used unless the disclosure is permitted by law. I said it already. Disclosure is required by law. Either permitted by law or required by law. Permitted by law, let me give you an example of permitted by law. All auditors or audit firms are permitted to report money laundering. Yes, that is permitted. But disclosure is required by law. The court can also order you to come and disclose your clients. They are investigating, so they want to know whether you have seen something or done it. And if you have seen it, you have to disclose. So the court is requiring you to do so. There is a professional duty or right to disclose when not prohibited by law. If you are required by the profession, it's your duty, professional duty or right to disclose, you can disclose. Recognize exceptions to the duty of confidentiality. Recognize exceptions, meaning that we are not supposed to disclose, but under some circumstances, you can disclose. Disclosure permitted by law and authorized by the client or employer. Yes, that's it. By the client or employer. Disclosure permitted by law and authorized by the client or employer. I will explain this thing into detail. Disclosure required by law. That one is straightforward. Professional duty or right to disclose when not prohibited by law. These two, we disclose them. The first one, at this level part 3, which is the final level, if you write only and say that disclosure permitted by law and authorized by the client or employer, there is a danger somewhere. You see, authorized by the client. What about if you ask your client, can I have this, McDo is asking me about so and so, your managing director's salary. Can I disclose to McDo? And he may accept that you can disclose. But tomorrow, you know the mind he has. Tomorrow, he may be thinking that you have been disclosing some things to people. It's only unfortunate that this one you ask him. So, you see, the confidence your client may have in you may not be solid as. So that one, if you are writing your, what do you call it? You are answering your question, and this one comes, and you say disclosure permitted by law and authorized by the client or employer. Add it that this one, if you do it, the possibility of your client, confidence in you reducing is very high. You see, so add it, and that shows that you are a professional man. Improper use of information. A member should not use or appear to use confidential information gained in the course of professional work for his personal advantage or for advantage of a third party. Yes. So confidentiality still. Confidentiality of working papers. An accountant's working papers, which contain what? Confidential information. Confidential client information are the property of the accountant and should not normally be made available to outside parties. So your working papers are yours. It's for your client. So please don't give it to anybody to use. That's what. Conflict of interest. Conflict of interest can arise under two situations. So there are two situations that can call for conflict of interest. Conflicts between members and clients. So as an audit team member, and your clients, conflicts can happen there. Members of firms should not accept or continue an engagement where there is a conflict of interest between the member or firm and its clients. So your clients and yourself, if there is a conflict, please, it means you shouldn't continue the job. Safeguards against that one is accountants should have procedures in place to identify possible conflict of interest situations. Conflict of interest situations. The next one, evaluate the possible problems and then, where necessary, act to manage or avoid the conflicts. Now, conflict between competing clients is a different one. The first one was conflict between you, the auditor, and your clients. The second one is conflict between competing clients, Vodafone Ghana and MTN Ghana. They are what? They are rivals. They are competing. So it means here too there may be conflict. The firm has a professional duty of confidentiality and so will not disclose confidential information about one client company to its competitor. So they are saying that, assuming you are auditing Vodafone Ghana, and then you had information about Vodafone Ghana, which are confidential, and you finish auditing Vodafone Ghana, and MTN has also engaged you to audit them. The two of them are rivals. So any confidential information you obtain from Vodafone Ghana should not be disclosed to who? The management of what? MTN Ghana. That's what they are saying. Possible safeguards are regular review of safeguards in place. Make sure there's a regular review of safeguards in place. 2, advising one or both clients to seek additional independent advice. Yes, you can ask any of them to seek independent advice. Then careful management of the clients. You must manage the client carefully so that there will be no wahala. Corporate financial advice. Corporate financial advice is another topic. Certain types of corporate finance services might create such conflicts. Yes, advocacy and self-review threats that the work should not be taken on. Audit firms shall not. So what they are saying is that if you are trying to do corporate finance services for your clients, the possibility of you being what? Affected. Your confidentiality will suffer. So in this case, they say don't do it. Advocacy and self-review threats. That is what you are going to create. So they are saying that audit firms shall not promote. If you promote, it means you are advocating. Promote, deal in, or underwrite an audit client's shares. Don't underwrite your audit client's shares. Then, provide corporate finance advice to an audit client, where the effectiveness of such advice is dependent on a particular accounting treatment or presentation in the financial statement being audited. So that is where you don't do what? Corporate finance advice, you give it to your client, turn around and come and do what? The audit of the financial statement. It's not permitted. It is a risk. Then advising clients involved in takeover bids or share issues. In this situation, there is a danger that the firm cannot give objective professional advice in the best interest of both parties. If you are auditing one particular company and you are giving them advice, and now they are going to merge, they are doing takeover, how will you be able to? You told them how to do some secret things, and then now you come out and say you're auditor. It is a risk. The firm may be in possession of confidential information related to each party. It means that this party, you know their secret. This one, too, you know their secret. Have you seen it now? So how are you going to manage that? With a risk that the information may inadvertently become available to the other party. So a possible breach of what? Confidentiality. Guidelines in this area are as follows. So if we want to guide against all these risks, then there is no reason in principle why firms should not act for both parties when a contested takeover bid occurs. However, a firm shall not be the sole or main advisor to both parties. You can be advisor to one, but not to both parties. Please. If the accountants are in possession of material confidential information and feel that their position in this respect is questionable, they should take advice from the appropriate financial regulatory authority. So if you are in doubt, you can go to CA and seek clearance or advice from them. That is one means by which you can avoid that. Thank you very much.